Hey guys, Greg Silverman here for CIOs and Bow Ties, another session of Come Learn With Me, where we take the most popular articles from last week that got the best likes, shares, etc., and we go through them together with you on a Come Learn With Me session. This one's really interesting. You know, SPACs have really got the market talking, and this one is a question that I've asked, so it's going to be a good one to come along and read with me. It says, the market minute, why are so many SPAC targets EV, electric vehicle companies? Good question, huh? So just remember, we highlight everything that's pertinent, and we summarize that down below in the article. So you don't have to listen to me or you don't have to read the article, but come along, let's see. Several weeks ago, I was chatting with Patrick Healy, this is by Sophia Kuntara, founder and president of Caliber Financial Partners, about SPACs. He pointed out that many of the targets of special purpose acquisition companies, also called blank check companies, were electric vehicle startups. Later on, while I was compiling a list of all the announced VC-backed targets, and there's a link there so you can check it out, I realized he was absolutely right. Thanks, Patrick, for the column idea. Several companies that have announced they're going public this year through a merger with a SPAC or indeed related to electric vehicle technology. Perhaps the most notable EV-related blank check target was one of the first startups to put SPACs on the map, electric truck maker Nikola Motor Co. Went public through a SPAC merger in summer 2020, and it was one of the few high-profile SPAC transactions that helped make blank check company mergers in vogue. DraftKings and Virgin Galactic were the other two. This year, a slew of electric vehicle companies have announced the intention to go public through a SPAC. Among them are electric bus maker Proterra, charging station company EVgo, electric truck startup Exos, and Lucid Motors. Heard of Lucid? So why are electric vehicle makers and EV adjacent companies such attractive SPAC targets? There are a few possible reasons. Revenue projections versus actual projections. I guess I know what that's going to say, right? I circled back to Healy, and according to him, a key part is that SPACs allow for companies to use future revenue projections, something an initial public offering does not allow for. The reason I think EV and high-growth companies are being targeted by SPACs largely has to do with the fact that some of them do not produce revenue, as Healy told me. The way they are able to go public through a SPAC is the SPAC process allows them to use revenue projections out in the future to entice investor demand, whereas if you do it through the IPO process, the SEC doesn't allow you to do that. Okay, very pertinent, isn't it? And of course, some of the revenue targets are pretty big. Some of the makers of electric vehicles themselves have not actually brought a product to market yet. Nikola and Lucid, for example, don't have an electric vehicle available for purchase. Electric air startup Lilium Air Mobility, not exactly a vehicle, but also an electric transit space, also announced a plan to go public through a SPAC this week, and rival Joby Aviation said in February that it would go public through a blank check merger as well. Neither has a product on the market. But there's enough promise that these companies will have a vehicle on the market eventually that some investors want in on the deal. Capital-intensive businesses. Electric vehicle companies are also capital-intensive businesses, so they need money to grow. Raising capital via SPAC rather than traditional venture capital financing probably presents better terms in the market, Healy said. The companies likely wouldn't have to give up as much equity or dilute existing shareholders as much as they would if they got a cash infusion from a VC firm. That's a good point. Giant market potential. Brian Walsh, head of Wind Ventures, the corporate venture capital arm of Chilean ventures company Copec, said there are a few reasons why SPACs would target EV companies specifically. First, Tesla's stock performance over the past year indicates we might be at the point where electrification can be mainstream, according to Walsh. The question of consumer risk, will the dog eat the dog food, as he put it, has been answered. But there are other factors too. EV brings together two huge markets that have been historically separate: transportation, fuel, and electricity, to create a giant market. Lots of good points in this article. It's a huge opportunity that will attract large amounts of capital, Walsh said. Competitive pressure. There's also the issue of competition between EV companies and market enthusiasm. Even if an EV company isn't considering a SPAC, it's hard not to consider one when its competitors are bolstering their balance sheets via such deals. We have 3 SPACs in our portfolio, and a lot of them are saying, listen, we're in the EV charging space, or we're in the electrification space, or we're in the energy storage space, and our competitors are doing SPACs. So even if we don't want to do a SPAC, they're getting capitalized, Walsh says. A series of public policy moves have made it so that EV is the future. California introduced a mandate that all new cars sold in the Golden State must be zero emission by 2035. The United Kingdom and Norway have introduced similar mandates, and legacy automakers like General Motors and Ford have publicly announced their commitment to an electric future to comply. I think investors, perceive this as a massive long-term opportunity, Walsh said. These transitions don't happen often in history. They're talking centuries or decades apart from each other. Well, there you have it, folks. That's super interesting. So that's why SPACs are targeting EV companies. Come join us for another session of Come Learn with me. You all take care.